The oil market today is experiencing a significant transformation into a new paradigm. We use the term new oil order to describe this transition that the market is going through. And we like to describe it in the context of three different areas. One is supply. When we think about the production process with shale, it has turned oil production into a standard manufacturing process. And what do I mean by that? It means I go out and spend money today, 30 days later I have production. I like to say it's like producing paper clips. You can dial it up, dial it down in very short order, which is a very sharp contrast from the old days where you go out, build a deep water offshore platform, it would be producing for the next decade, and you really couldn't change that capacity very easily. Point number two has to do with the demand side. And the demand has changed tremendously with the United States approaching energy independence. Previously, when the U.S. was importing so much oil, it was the marginal consumer. When we think about price spikes, they actually had to occur in U.S. dollar terms to get the U.S. consumer to back out of the market. Today, we look at the world, the emerging markets are the marginal consumer. It's no longer the U.S. The U.S. is more what we like to call baseload demand. And so the margin of adjustment is happening in places like China, India, and other parts of the world. The third component has to do with the market structure. Because of the very flat supply curve that's generated out of these shale technologies, OPEC has lost much of its pricing power. Think about this. When the supply curve was very steep, if OPEC took oil out of the market or added oil on the market, it'd have a significant impact on price. Today, because of the very flat supply curve, if OPEC adds oil on the market or takes oil off the market, it doesn't have a significant impact like it did previously. The other important point about this, because you can dial the production up and dial the production down, it takes out a lot of the volatility in the market. The question of how this market rebalances itself over the course of 2015 is going to be one of the most fascinating economic problems this industry has seen in decades. A key thing to remember when we think about this rebalancing process is that oil and gas producers have a lot other options available to them than simply just cutting output in response to lower prices. They can lower costs themselves and become more competitive, grow volumes to actually keep revenues constant in the lower price environment. They also have the option to sell shares, sell their equity, raise cash that way. They also have the option to increase their liquidity to survive a period of relative low oil prices until somebody with deeper pockets actually buys them out. So there's a lot of options available here, which says that how this rebalancing process takes place is going to be very interesting and very unpredictable.